Module 8, mistakes I see people make. A lot of these are just mistakes I made myself. I try to speak from experience. You don't want to come across as giving people advice. None of this is financial, legal, tax advice. They're just merely things that I've learned through my own personal experiences interacting with high net worth individuals out there. First, this in the early days and then more recently, first property was the wrong property in a primary market. As you guys know, primary, secondary, and tertiary markets. Primary markets are like your Seattle, your New York, your Boston. Great places to live, great for appreciation, but too expensive. Today, we focus more on secondary and tertiary markets like Huntsville or Savannah, Georgia. Secondary markets are more like your Dallas, your Phoenix, places like that. Today, we focus on more workforce housing. My first property in Seattle was an A-class rental. Classes of properties are mostly dictated by the vintage or when the property was built. 2000 or later is considered A-class. 1970s to 1990s is what B class, and anything less is considered C class. When I first started, again, bought that A class, again, very similar to buying in primary markets. You're just not going to get the price dynamics where you are, the price per unit to be able to cash flow. And you're just competing with residential home buyers, people on that luxury side. And this is why we focus on workforce housing, class B and C properties. There's a temporary dynamic where a lot of new supply is hitting the market, which should subside in the next 2 to 3 years. Not a lot of people started to build once interest rates started to go up in 2022, going into 2023. So you extrapolate off 2 years from there. So that is when a lot of people stop building. Even ourselves, we develop multifamily apartments and we put a lot of projects on hold. We didn't stick a shovel in the ground because the cost to get construction loans in this high interest rate environment are getting into the double digits, 10, 12%. Long term, workforce housing, BNC properties, I think we can all agree that this is where it's at with the dynamic of the workforce housing population, the lower middle class growing with immigration. Population in America is generally growing. The bifurcation of the rich and poor, the rich are getting richer, but the middle class is shrinking to the lower middle class, thus needing to get into an apartment as opposed to buying that single family home that once in the golden era people aspired to. A general movement towards newer assets. People are willing to take a little bit smaller footprints for newer fixtures, kitchens, things like that. All of things of which can be easily renovated in an apartment. You put a little lipstick on the pig in some of our value add projects, and that's a product that people want more and more these days, especially within their more value and price points. So today we're focusing on more B plus, A minus assets, but long term, the workforce dynamic, the B and C property should come back. We like to invest off the macro trends that don't change every 5 to 10 years, such as workforce housing. People always need a place to live. Every 2 to 3 years, supply demand dynamics may change slightly. For example, people talk a lot about investing in this state or that state. The Sunbelt states from a high level are great, but I'm not co-signing that statement quite yet. What I want to be doing is going into specifically like what submarket in a market like Phoenix, for example. Phoenix might have 15 to 20 different submarkets or neighborhoods in that geographic area. Not all of those submarkets are emerging and growing. Some are decaying. But overall, sure, a Phoenix, Arizona, or Arizona is a great place to invest. You got to dig deeper into the submarket. Some of these statements here are a little bit contradictory. We still do the multifamily value add where we have to deal with tenants, even though I'm saying when the one common trend is we're trying to get away from lower end tenants. When we first started, we would do a lot of class C, low end class B assets. And it's just difficult working with that clientele because they just don't pay. It's not common to have your delinquency in the 20% range, meaning only 4 out of 5 people pay on time, if at any. Part of the trend recently to get to a little bit nicer assets, a little bit better clientele. And that's in our multifamily value add space. We also do development. And with development, there are no tenants. Most of the project is just building it. When you finally build it, you're leasing it up with more class A tenants who tend to not have trash the property on their way out and huge delinquency, such as the low end properties. We're trying to get more on the private equity side buying businesses. Obviously, no tenants on that side there. Perhaps you change that out for clients and people using professional services or brick and mortar private businesses that will go in and do an M&A on private equity. But that's expected for any business. The biggest thing when from a high level, what I never liked when I was a single family home owner was just being exposed to a tenant living in your property and then something goes wrong in their life. They go a little crazy and they just totally trash your property. I've had to evict about a dozen people when I owned single family homes pre 2015, 2016. One third of those times, the tenant just trashed the property and I was left with a ten to $20,000 repair bill. This is why a lot of these things I talk about have been my experiences, but also the experiences of other people I've met. Single family homes, as we discussed in a previous module, just are as not the way to build sustainable wealth in the future unless you're looking for a day job to manage 30, 40 of these little rental properties. And that's why the movement towards private placements and syndication is more of the way of the future for most people out there, growing at least to $1 million or greater. I'm bringing this chart out. People are always asking, all right, this information is great. We're already to the 8th hour of this masterclass. What do I do? I've always been hesitant to give specific advice. I'm not here to give tax or legal services. I'm not a certified financial planner. I'm not telling people how to differentiate their asset allocation mix. I'm merely here to explain how I did it and maybe give some ideas from the other side of the railroad tracks, if you will, the alternative investor side. I came from the traditional investment world, investing in the 401k, where you have X amount of large cap stocks, your S&P 500, if you're a little risky, you got some international mutual funds or funds. If you even are like that, maybe you're just somebody who just has the target date funds of retirement. When you get off into this alternative investment world, you've thrown asset allocation out a window and you're picking individual deals to invest in. At one time, I attempted to allocate $500,000 out of your portfolio, which could mean coming from a guy who has $1 million net worth, which would be half of their portfolio, or could be a guy who has $5 million net worth and is just merely trying to invest 10% of their portfolio. This would be the way that I did it initially. On the bottom, you see turnkey rentals at $25,000 a piece as down payments on $100,000 properties. The syndications get you the leverage on your own, obviously, because the general partners keep principal, son, and debt on your behalf, which is nice, right? You're not the loan guarantor on those projects. I started with a bunch of things that made much more sense to me that I seemed to be a little bit more sensible. Multifamily, class B and C, workforce housing. What more simple can you get? And I would urge people to start there because you've likely lived in an apartment or rented houses out in the past. So it's a business that is tangible. I actually do think it's a lot easier than, say, a assisted living syndication or a hotel syndication. Unless you've worked in the hotel industry, you likely don't have the personal experience than you would of living in an apartment. There are other investments on here. That's just how I learned. I invest in things. I didn't know anything about mobile home parks at one time, and then I started to invest in it and pay attention to it. This is maybe similar to crypto. I don't invest in crypto. I think the blockchain phenomenon is a great idea of decentralizing everything, but I focus more on real estate and this types of alternative investing. I did throw maybe 5, 10 grand into that world because if I don't have money in the game, I don't start to learn. This is what we also explain to other investors. I think one of the big things is to get around other purely passive credit investors. There's no other group as community based than ours. We have an annual retreat every year. Typically in Hawaii, where I live, people come down, break bread with each other. We have table topics. We have lightning rounds of structured networking. We do some sightseeing together. It's all structured in a way where people build relationships with each other, which for me, getting started in this world, the absolute critical part. You want to know more people who are passively investing along on with you than you want to know operators. Some people have lists of operators that may invest with. It's the opposite way around. You want to start with the passive investors. I think this is a little bit more of an alternative mindset, more of a long journey to get to where you want to be. Trust me, in the future, a lot of you are already a million, few $1 million net worth. It's not going to take you very much to get to the other side of what I call end game, $4 to $5 million net worth, where financially you're set. And by joining a group like ours, you set yourself up to interacting with people who are like this. We try and filter in the right people and keep the right people around that have the mindset of people first. Relationships are the currency of the wealthy. Part of this is to grow the knowledge bank. Unless you start to build your portfolio on your own, like we've shown here, I still think our folks are really cool and I coach and I set the tone where everybody's giving back to each other in a mastermind format. I think if people are just starting to interact and meet people face to face in this world, if you haven't invested in a handful of deals quite yet, is somebody really going to interact and really want to invest a long term relationship with you? I don't know. I hopefully I'm wrong here, but nothing is better when a guy is in a couple of deals talking to somebody who's in like maybe 6 deals. They're both on that same stage of growing their portfolios to dozens and dozens of these assets. And nobody's going to come out and say, hey, what's your net worth out? Right. And even if you were to say, this guy's $2 million, this guy's $6 million, it doesn't really matter at that scale. It just matters like what's your experience investing in these types of projects, how many deals you're in. That's why we say maybe get into some deals first, get some street credibility, and then you really start to interact with other purely passive investors from there. Start meeting folks, come out to our events first, and maybe that's a way you can get going and get more confidence investing in this world more and more. The next mistake I've seen, and I did this when I first started, say 2009. I was on this linear path to go and buy a home. And why? I don't know. I just follow what my parents told me and what society told me. Go to school, study hard, become an engineer, invest in the 401k, and buy a house to live in. What we'll say about buying the house to live in is it's the right path for most people. But if you're listening to this masterclass, you are not normal. Your net worth is likely a lot more than the average person. You make a lot more in salary, well over 56 figures a year. So you're not normal. A lot of you folks are really good with money. Like myself, you're good budgeters, you're good savers, you're good investors. You may not put in alternative investments yet, but for those, let's call it the non Susie Orman, Dave Ramsey followers, right? A lot of those folks are what we call in the basement level of the wealth elevator. If you guys have read my book, we briefly talk about the basement level of people under 50, $100,000 income a year, and not yet to $250,000 net worth. Those people need to buy a house to live in for it to become a forced piggy bank. Because if they're not paying their mortgage every month, they will take that money and spend it on frivolous things. If that doesn't apply to you, you see where I'm going with this, right? For people putting money into a house as a down payment, it's some of the laziest equity in terms of where you can be putting your money. If your net worth is not yet 3, 4, $5 million, you need to grow your money at a rate higher than what your house grows. You don't get any extra depreciation. You get depreciation off the interest. Whoop-de-doo. That's nothing. Don't get fooled into that whole lie by mortgage brokers. But it's pretty insignificant when you compare it with getting depreciation by investing in real estate. The cost segregation's getting even more out with the bonus depreciation to play some of the games, but the taxes that we've talked about in a previous masterclass here. General rule, and I think for most of our investors who come to the masterclass here in their 40s and 50s, you've already bought your house, and that's totally cool. Some of you have kids in their 20s and 30s. One of the rules of thumb I'll say is don't buy your home until your net worth is at least 2 to 3 times that of your home, even when using financing. A lot of us live in high price areas, California, Hawaii, even places in Texas are getting up there. If you're thinking Texas is $500,000 home, multiply it by 2 to 3, and you shouldn't be buying that home until you are net worth 1 million to 1.5 million. Or if you live in California with that starter home of $1 million, until your net worth is $2 to 3 million. Now you're probably thinking that's absurd. Where do I live? You'll rent. I still like to rent. The way I figure is a house in Hawaii would probably be about $1 to 2 million and a down payment on that because you max out on these jumbo loans at a certain point. I'm going to need to bring $500,000, maybe even $1 million down payment to the table that I could be putting into syndication deals and other investments. A lot of us live on the other side of the paradigm, right? These jumbo loans max out at a certain point. So we're going to have to bring so much money to the table. And that even makes this argument even stronger, putting it into other investments. Because at the end of the day is you got to look at every single dollar you have and what is your return on equity. Part of this, I get it. It's tough. Not everybody can have an amazing spouse like mine's. And I say that because hopefully she's listening, which she doesn't listen to any of these things I do like this. She's not super interested in this stuff. But at least I thank the universe that she is understanding enough to understand this little module right here. That in the long run, renting will be advantageous for us because I can take that money and invest it at some inflection point. For most people, when they get past $3 to 4 million, they can start to do things that aren't the most money smart things to do and buy a house to live in. But that's with you and you guys' marriages, and you guys need to figure that out. Of course, come to a retreat one year and talk to people in the same world, in the same space, and you can get more personal and help people deal with many problems. These are problems to have, I think. It ultimately comes down to this concept of return on equity, which also applies to buying a house to live in and buying a rental property. Keep in mind buying a house to live in, your home, in when you think of this concept, but also keep in mind of a lot of us might have already bought rental properties. And this is the number one mistake that most amateur landlords make. They buy a property, pay down the mortgage, and then try to pay it off over time. Now, it's not specifically that strategy is wrong, but it's more of the timing of it in terms of where is your personal net worth in the grand scheme of things. On the left side, you have return on equity. Return on equity is different than return on investment. Return on investment is the metrics that are put into place or you calculate on the entry point of your investment. And just simply put, it's how much money you make divided by your initial investment. When you're first going into an investment, your return on investment and your return on equity should be pretty much the same because time has not come by and your equity has not changed. But over time, as the property appreciates, as inflation has happened, as your tenants are paying down your mortgage, all these are good things and naturally happen over time. But your amount of deployable equity starts to go up. So that means if you're following along in terms of math, the numerator, how much money you're making from your investment, is generally staying the same. It might go up with inflation, but on your denominator is getting bigger and bigger, which is creating this percent return on equity dynamic to go down over the years. Investments are all different, but generally they follow the same curve where at some point you're dipping into single digits. So a classic example of this, and I don't want to offend anybody if this is you, I just want to make you aware of the facts so you can make changes. I mean, I live here in Hawaii. There's a lot of amateur landlords that own $1 million homes that have paid them off over time. $1 million home out here in Hawaii will typically rent for $3,000, maybe $4,000 a month. But let's just say it's $4,000 to give them the benefit of the doubt. But at least one fourth of that will go to expensive. Some would argue 50%, but let's just be conservative here and put it into the landlord's favor. So that $4,000 rent equates to $3,000 of profit at the end of the day. They don't have any debt service, so that's $3,000 is basically their profit. So $3,000 times 12 is $36,000 a year is their income. Now divide that by the denominator on the return on equity, which is $1 million, comes out to 3.6%. That's pathetic. That is a pathetic investment. Let's be honest. I'd rather have my money in T-bills for the amount of legal liability, things breaking, and headache in owning a rental property. Now, sure, when they initially loaded into that investment, the return on initial investment on that house, because they probably took out a loan and the property was a lot cheaper in price. Probably when they bought the property 30, 40 years ago, the price of the property was less than half. Let's just call it $400,000. I don't know what it is, but I'm just taking a guess. Might be even less. $400,000 house, then maybe they put down $100,000 back then. That's a lot of money back then for a down payment. They probably bought it for a lot less, put a lot down. The $100,000 was their initial investment. So at that time, they probably rented it for maybe $2,000 a month, and they made 20 grand a year. So that's in the numerator, and on the denominator, you had that bigger number because the initial investment was so low. They made 20 grand divided by $100,000 was their down payment. So that's 20% right there. Again, probably a lot more, right? And that's how these deals typically start. They start pretty high, but over time, as the property appreciates and the deployable equity increases, this number of return on equity, deployable equity, which is really how you measure an investment over time. So, what do you do with this information? At some point, you leverage or sell the asset and you go into more and more deals. And you keep doing this. And this is how you grow your net worth over time. And that's the tricky part. When do you do it? You certainly do it before you're getting a 3.6% return on equity. It depends on where you are at as an investor. And where you are an investor is all what your network is. And that's why people join our community to get access to better deal flow. Retail investors, normal people struggle to find anything that beats the 10% threshold. In our world, people typically find things between the 10 to 20% range. For professional investors or family office investors, they're able to find amazing deals. But unless your net worth is 50 million, $100 million or greater, and you're incredibly network and connected, you're not going to access that threshold. But that's why people join our group so they can build their network over time, potentially getting there in a couple of generations. This is not a get rich quick scheme. This is a slowly grow your portfolio, but also grow your social capital, getting your kids involved into a group like ours. I'm big on people bringing their kids or the son-in-law to our events so they can start to intermingle with some of our younger folks in their 30s and 40s, growing those relationships and see where that goes into the future. Not necessarily to do deals with each other because we're not that type of group. We're all just passive investors here. But the family values grow within the generation too. Ideally, my vision is when I'm not here on the earth, the group continues to evolve in that fashion. For those of you who are engineers, we have a lot of engineers in the group or had to go through physics class. You're probably seeing the concept of it's area under the curve, right? In the default normal mistake path, the area under the curve is not very much. If you're able to prune the portfolio and re-leverage into new deals by either selling, refinancing, buying more assets, you're able to increase this area on the curve temporarily. And then you just have to keep playing this game. When does this game end? This is obviously just looking at one investment of dozens and dozens of deals you probably should be getting into. It's a game of doing this just enough to get to your personal end game. And this is why it's important to interact with other investors because a lot of people in our community try and shoot for about $4 to $5 million net worth as a baseline of, all right, when I get to that level or a certain age, I could sunset on my investing. At that point, you could theoretically just pay down your properties or not invest anymore, and you're good. My goal for everybody is to get to that point as quickly and as safely as possible so that you can live the life of financial freedom as long as you can. It's going to require you to get off the beaten path, which is why we try to provide people with the community and network to get there together. At the end of the day, we're only given so much time. And that's why there's urgency to get to that path sooner than later. One of the rules that I follow today personally is I only take financial advice from people who are financially free themselves. When I started to interact in a lot of these accredited investor circles, I was surrounded by people 20, 30 years older than myself. Strategically, that was exactly who I was trying to seek out. I was in my late 20s, early 30s when I was in this world as a pupil. I think people like me and they like somebody who's involved in the world. I had 11 rentals by 2000. I think I was about 30 years old at that point. And people like to help me, which goes into relationship building. People like people they like and they want to help them. Part of it too is strategically on my side. I wanted to get around people who are my pedigree. If I kept on investing the way I did and became 40, 50 years old, I wanted to find those people. Right? I wanted to learn their mistakes, their best practices. I wasn't going to go seek the advice of a trust fund kid who just was born with $20 million and now had 10. Like that joke people say that I don't think is a very good joke. If you want to make a lot of money, start with a lot of money. That's why not a lot of people in our community are trust fund kids or go to the country club. That's just not our pedigree. I certainly wanted to find people who are further along on my trajectory. So I tried to find engineers, doctors who were in their 50s that had $4 or $5 million net worth at least and pick their brain. That was actually where I found not only the investing thing, but the accredited investor banking, the infinite banking, enhanced mode, and a lot of these tax strategies that they themselves were utilizing. Certainly not your normal financial planners and real estate agents. Real estate agents, they're just salesmen. Most real estate agents play in the residential world, which is very different than the commercial world that we like to invest in because they're more institutional investments and a lot less competitive, right? People buying little single family homes is everybody out there in the world. It's like amateur hour. Or the commercial world, you have a lot less competition. Mortgage brokers are salesmen to get you a loan from the big banks or lending agencies out there. They're not investors. I think this stems from CPAs, right? Why would you want to take advice from a bean counter who hasn't figured out these tactics or started to invest in real estate themselves to getting them on the fast path out of working a day job? A lot of these CPAs are very much rule followers. They may have some understanding of how the tax code works, but maybe not the best practices that the wealthy have. Not to knock CPAs too much, but I think there's a minority of CPAs out there that get this type of stuff. Some people will say, I want a CPA that has a lot of gray hairs, a lot of experience. In reality, that's like the worst people to go to because they're stuck in their ways. And more importantly, their client list is very mature. They don't need to do things the hard way, right? They want to do things the easy way. I've always tried to find CPAs who are on the younger side that are willing to try different things. This is actually how I do it with my attorneys, right? People who are on the cutting edge really into research and doing things, finding that next best practice because the world changes so much. Land conservation easements, oil and gas deals. Some of these things move so quickly that most CPAs or attorneys they're just not able to keep up with it, especially if they have a thriving practice. I don't want to overspeak my bounds, but doctors potentially the same thing. Sure, you become more experienced over time, but you're not expected to read every single new medical journal and article that comes out if you have a thriving practice. At the end of the day, like, why take advice from somebody who still has a day job that wasn't able to figure this out? I think what's cool about this world is if you implement alternative investing, obviously at your dosage level that's appropriate for you, these tax strategies, that's why the alternative investments are so cool because they unlock these passive losses for you to play these alternative investment strategies some of the past clients we've seen come to the family office group, they're able to cut their tax bill by at least 20%. And then the infinite banking too. When they combine these three strategies, which I call the trifecta, you're able to get to the financial goals that you want to get to $4 or $5 million net worth in about a third of the time, where it may not take a decade to get to where you want to be if you start today. Whereas most people, it takes them 30, 40 years if they even get there, if they even have the income to do that. And certainly don't listen to the people in the cubicle lab. This is probably the big reason why I finally quit my day job because I just couldn't stand the silly financial advice like the old heads would give to me. Like, why would I want to listen to an engineer who's been at that job for 60 years, who wasn't able to get himself out financially? I mean, at the end of the day, net worth don't lie. Net worth is your assets minus your liabilities. I don't want to come across as rude, but numbers don't lie. How much money you have, assuming you create it yourself, speaks to the level of sophistication you may have. Essentially, that's the score of the game. Another mistake that I made early on, right out of college, and I lost a lot of money doing this. Thankfully, it was in the early part of my career and set me on this trajectory of investing in hard assets where you have the influence to value add the asset. But I did a lot of swing trading. I was in my early 20s. I caught on to watching Fast Money on CNBC, the Jim Cramer shows. It appealed to me because there was a lot of numbers, fast, and it was sexy. And maybe I aspired to everybody was dressed up in suits, a lot more white collar than I think a lot of the investments that we look at today, which are a lot more blue collar. Who's buying a 200 unit apartment complex in Texas or more rural part of the nation, right? It's not super sexy, but this stuff appealed to me at the time. And this is right around the 2008, 2009 downfall, which was horrible for me from a money standpoint. Successful people say failure is typically where people rise from the ashes to make changes and eventually move into the right path. From an asset class standpoint, stocks are very volatile. The good thing about them is they're liquid, where you can trade in and out of them. Real estate, once you're in, you're stuck. If you're somebody who makes a gazillion fantasy football trades every week, or more on the emotional side where you buy, sell, this, I guess, disadvantage of real estate can probably be good for you. You stay the course. But I personally don't have any stock market assets. I probably should. I'm more involved on the operator side of the real estate portfolio and acquisitions. Maybe I'm not a good person to personally follow, right? I'm just sharing my story. I'm not giving any advice here. I'm just not a fan of the stocks world. The biggest reason I just can never really get on board the way I saw it, it's not the price of the stock is not really dictated by the performance of the company. It is in a way, but there's a big thing in there called the expectations of Wall Street. It's funneled through the expectations of Wall Street. So you can do really good on your financials, but if the expectations of Wall Street was higher, the stock price goes down. Or if somebody says something stupid from the C-level suite or something controversial happens, the stock goes down. From those two things, I was like, I don't have control over that, but I can't really predict those two things. I can't predict what the expectations of Wall Streets are, and I don't know what it is. Wall Street doesn't even know what it is. Real estate or buying businesses, we have direct control over renovating a unit and then the tenant paying $100, $200 more in rent. That goes directly to the bottom line that increases our net operating income, which increases the value of our building. We talked about that previously in a previous masterclass where we went through some situations where say we have 20 parking spaces at $100 that we're now charging, we increase the income, how that increases the bottom line of the asset. There's direct impact into the the force appreciating that asset, increasing the value where we take fate in our own hands, as opposed to the stock market where you don't have control. And then don't get me started with the mutual funds and the REIT world where you have so many layers of fees. That's why we like to invest directly in private placements and syndications with the sponsor or be the operator ourselves, where we cut out all those middlemen and financial planners, etc. And then you get caught up in a lot of these emotional fallacies, like the sunk cost fallacy is an example. People going to a movie. Movies are pretty expensive these days. You sit through a little bit of it and it's not a very good movie, but people would rather just stick it out. With real estate, you're stuck in it to the end with the lack of liquidity, but with stocks, you got the ability to leave. But what if the movie turns around, or like a basketball game? I don't know if you guys remember when Tracy McGrady, when he was on the Rockets, scored like 23 points in 37 seconds. I will admit, I was watching that game and I went and took a shower because I wanted to get ready to go out with my friends that night. I missed one of the most iconic moments in NBA history where he did that. A little sad of that. Still think about that today, but I would have missed out on a great experience, or in the investing world, you miss out on returns. So what typically happens, people will follow the herd and do exactly what everybody else does. And when you do this, you typically get slaughtered like everybody else, and you emotionally get out when you probably should stay the course and things go back up. But you're in it when things are riding the high and the frothiness of the market, and you buy at the peaks. Now, I'll just go over the advantages of real estate. I think there's a big difference between me. I used to buy a single family home turnkey rental or buying a house to live in. That's not the real estate we're talking about here. That's buy, hope, and pray strategy. What I'm talking about is value adding the asset. If you're investing in a development, you're not going to have the cash flow in the investment. You got to wait to the end. When you're talking value add deals, at least how we try to do it, when we're trying to pick up stabilized properties, you've got the cash flow yield there, you got the equity build up, and you've also got the force appreciation value add there, which you can't do that with bonds. Cash savings don't have that. Publicly traded stocks, in theory, the CEOs, they're getting paid handsomely for this, but they're trying to increase the value of the businesses, right? Doing things every day that make it better, more profitable. From a real estate point of view, it's the only hard asset. Everything else is a soft asset. Now, when we get more into the private equity mergers and acquisitions mode, we may be picking up, say, engineering firms as an example. That is a soft asset. There's hard assets in that, such as the furniture, stuff like that, but it really is a soft asset in terms of the Rolodex, the intellectual property. But that's why people like real estate. And from that comes the tax advantages, right? You can depreciate those hard assets, such as the real estate, the equipment, where you can't really do that off of any other investments. Bonds has some tax advantages, but the returns from bonds is pretty much a fraction that of everything else. I just always want to point things from a transparent standpoint. I think that's why people like us. There's always like pros and cons. With real estate, you don't have the liquidity, right? You're not able to come in and out of deals. Once you're in, we're all stuck with each other. That's my young kid. She's 3. We get in a car and she always complains, I want out. I got to go to the bathroom. I'm like, you're making that up because we just took you. And second, we're stuck. You're not getting out until we get to where we're going. Like how it is with these real estate deals, right? That's why you diversify over time. The idea I picked up from other people is you try and space out your acquisitions when you go into deals. Maybe you put 100 grand every quarter. Ideally, they're all on different timelines. And normally these deals typically last a couple years to 5, 6 years. All things being equal, if you're going into deals routinely, at some point they should free up and create that liquidity flow for you. You can start to build a pipeline for yourself. All these have their pros and cons. I have made a living in one of them and it has worked for me. Different asset classes are somewhat counter-cyclical to each other. Where I'm trying to get to personally is there's a nice mix for everybody. I don't know what that mix is. And this is where you have to self-educate with smart individuals and find the best asset allocation mix for yourself. I think what we try to do here is focus on real estate and private equity because that is most what retail investors lack in comparison with more professional investors, family office investors. They will typically have a much higher concentration of those types of assets than your average investor out there. Now, continuing on the list of, mistakes that I've made, the 401ks, 403bs, TSPs, IRAs, or we'll refer to all these as qualified retirement plans or QRPs for short. what we're all taught is to put money into these 401ks so that we have it for later. I think, again, just like the Dave Ramsey stuff, where most people, this strategy really applies because most people don't have very much money and they need to save because they're bad savers. You listening may not fit in that category, right? Especially if your net worth is above $1 million and you're a good saver. There's a different set of strategies that apply when I'm saying to consider the retirement funds. Putting money into QRPs may or may not be for you for these variety of reasons, which these are very counterpoints to what we're all taught. So if you have to go back and rewind this section and then maybe come back and listen to it later on. But number one, you have a higher tax when you're increasing your income and you'll be in a higher tax bracket in the future. Here on the right side, I have the tax brackets in 2022. Generally, they go up and down with the pace of inflation, but they're generally the same graduated income based off your income system exists, where the more you make, the more you're going to get taxed on that graduated income step. The more you make, the higher the taxes you will pay, essentially. I think there's a misperception out there by people saying that when you're older, you'll make less money, you'll be in a lower tax bracket. That applies to most people, but not you. I think from all of us standpoint, what we're trying to do is grow our asset column so that asset column grows way more than what we're making at our day jobs or ordinary income to a point where well before we retire, the column is making so much in income that it's actually going to create more overall income for us than what we're making today. That's the whole freaking point of this. So we can create this perpetual income stream from not working and trading time for money. If you're into that and you think that you're going to get to a point that's going to happen, you actually will be in a higher tax bracket when you start to take money out of retirement funds. And you're probably thinking, man, was I duped into doing this? Which is actually like we find some of our older investors in their 60s who maxed out their 401ks and they have several $1 million in their 401k, but they are getting killed by taking that money out because their income is so high at that stage in life. And when I say it's high, it's relative to where they were in their working years. They might have been in these 20% ranges with lower income in their working years. And in their older years where they're taking money out, they're in these higher tax brackets. So if you're following along, what do you do about that? You try and leak money, these key monies out now while your income is lower now. Number two, taxes will generally increase to pay for government entitlement programs. I think this is the general trend. I'm not going to go too far off the deep end here politically because we try to be a non-political organization. I specifically say, hey guys, when you come to the retreat, please don't talk about politics. That's the best way to eliminate new connections. To me, politics, it's going to be based off your fundamentals. That's not going to change. So why would we even talk about that? Let's talk about things that I think are up to debate that we are open-minded about. But even myself think that the world that we live in is becoming more of a socialist state, at least go to that trend. Some of you who live in the socialist state of California probably see where that is going. We'll probably all agree that taxes are generally increasing to pay for these government entitlement programs. So if you believe that, take money out of your QRPs now and pay it at a lower tax rate today. Now, obviously, we don't know this. I'm just bringing up these ideas for you to consider to make the right decision for you. Number three, a lot of these QRPs, there's some type of trigger where you exit at a certain age. But most of us, if you do play your cards, you're going to be wanting to retire, maybe access this money well before you get to old age. And they keep changing the old age because people tend to live more. But if you want access to this money before that age, get it out of there now and bite the bullet. Now, this is where it gets to be more of a personal type of situation. If you haven't booked your onboarding call with us, we can talk about your situation. If you're age 58, 62, we may say you're maybe just stick it out a little bit longer. But if all your money is in these QRPs, then we got to get it going, right? So we may have to come up with a plan to leak it out. And then we start to look at where you're at in terms of the tax brackets based off of this chart. Obviously, these numbers tend to change over the years. If you're making $200,000 a year in terms of AGI, maybe you leak out $100,000 out of your QRP, pay taxes and penalties on it. So your AGI at least doesn't explode over this $340,000 mark or this red line amount where the tax brackets go from 24 to 32%. This is a pretty big gap. That's why this guy right here is a little alarmed. Number four, supposedly your money grows tax free, but with real estate, it does not. So one of the big fallacies I think people will say, or at least my parents used on me, was put your money in a 401k so it grows tax free. They are right. But if you're investing in real estate that gets you the tax benefits today through the losses, the depreciation, it's going tax free anyway. So it's a wash. There are certain investments that you put into your qualified retirement plans. And what some people will do is they'll take the money from their 401ks or IRAs and they will move it over to a self directed IRA or a solo 401k for their business owner. And so they can have the same advantages of these retirement plans, but be able to self direct into things like real estate or private equity and or even stocks, bonds, mutual funds, right? That is an option too. And if you guys are looking for a referral to these types of people, you can submit to our team at thewealthelevator.com/vendor or email team@thewealthelevator.com. We can connect you with the folks we're working with at the moment. Vendors do change over time. Sometimes they get mature and they get to a point where they just don't do cutting edge stuff. Or we've had it in the past where a certain professional services firm that we've worked with sell their firm to private equity and then the value goes down for customers or clients and that's where we stop working with them. I think the big thing is if you're investing in real estate or other assets that give you these losses, you don't want to invest in them through a QRP because say you invested in a syndication private placement as an equity investor, you're going to get a K1 and some great losses with it, if, especially if it's in a real estate deal. At that point, you get the losses, but it doesn't flow to you personally because it's locked up in your qualified retirement plan money. This is one of the biggest things. We want the passive losses to flow to us personally so we can use it today to mitigate our taxes today, right? Because the idea of time value of money. If I can save 20% in my tax bill today, I can invest that into a deal and grow that over time. If I don't get the passive losses from a deal today because it's stuck in my retirement account, I am not able to take the advantages and have it compound over time. So, five reasons to ponder. The big con that people always bring up is what about the 10% penalty? It sounds really bad. The way I would look at it is if you have to pay a one-time penalty of 10%, but you recoup that and if you're investing in things that get you a higher return, what's your crossover point? When you look at it, if you're going from a 5% investment to a 10% investment, you're going to recoup that in 2 years and it's all gravy. That's just one part of it, but also consider all the other intangibles and come up with the best decision. Now, for some extremely high income earners who make over $500,000 a year, it may make sense for them to utilize a qualified retirement plan, specifically a solo 401k or a self directed IRA. I think that it comes down to the dosage amount and prioritizing using investments outside of these qualified retirement plans first. This comes down to your own personal situation. We're by no means giving anybody financial advice here. What I like to do is get on a personal call and we talk through these 5 points here and then have you have a working knowledge for you to make a best decision for yourself. But then at least send you off into a working direction. But this is what's cool about the community aspect is you go off and you find other people who are maybe in the same threshold as yourself and possibly people who've already done what you've done, taken out their entire retirement account and put it to a QRP or taking it to cash and invest cash and simplify their life. That's what I've done. I've personally got all my money out of the retirement accounts back in 2014, 2013. That was what I used to go buy all these rental properties that greatly impacted my life positively and allowed me to grow my net worth at that critical time. You'll meet people like that. Maybe they can provide counterpoints or ideas. And this is where you have to pull this together. This is your responsibility. We trying to educate you on the building blocks of this, at least kind of paint this more of a neutral point, right? Where as opposed to we're all just brainwashed. And I was there myself. Invest in the 401k, get the company match, but then max it out. Some people out there in the alternative investment universe have realized that they're putting their money in their IRAs or 401ks, their so-called tax deferred accounts, which we all know that it may not be the best way. And specifically, number five here, if you're investing in real estate, you're typically getting losses to offset your gains anyway. Essentially, you're going to have to pay taxes on this, right? Because all you're doing is deferring your taxes in these types of programs. But what the government is doing in a way is the government's in huge amount of debt, and it's essentially a blank check for them to harvest whatever you got in the future, right? Like right now, the tax brackets are as such, they could just jack it up in the future. Or for all we know, they could create some BS law where they go and target people's 401ks and just put some ridiculous surcharge tax on there. I'm not saying that's going to happen, but it could. They need money and may look for things like this. Some people are like, I'll be damned if I give the government a blank check to harvest whatever the revenue I have from my hard earned retirement plans. I'm going to get my money out now. But we don't know, right? This is the whole argument between, I'm sure a lot of you guys are familiar. Oh, should I put my money in a Roth IRA or should I put it in a regular IRA? Nobody knows. I would probably say diversification because you don't know. You put a little bit some and a little bit in the other might be the way to go to play that uncertainty. But there are risks in both paths. Nevertheless, hopefully what we've done here is we've dispelled the whole the 401k is where it's at and make people realize that it's not all it's made out to be. Like I said earlier, there is one exception to the rule where if you make a lot of money, $500,000 or more, and you are less than 55 years old, it may make sense. This is where it gets really personal. We're not going to get to that level here, but it's a rare occasion. The other exception would be qualified retirement accounts, self-directed IRAs, solo 401ks. They're good for non-tax advantage things or real estate because you get the losses from it. If you're investing in things outside of real estate, like private equity, maybe you join a project that buys plumbing companies or digital marketing agencies, great professional services businesses with no hard assets, give you no losses because there's no depreciation of a hard asset. This might be a good place to put those holdings in. We're getting a little bit more advanced here. Some people invest in life settlements. Another example of a non-hard asset that don't give you any losses tend to put those types of things in these qualified retirement plan because you're not getting the losses from it. Therefore, one of the big advantages or disadvantages of it is negated. You're not getting the losses to flow to you since there is no losses. That negative kind of gets nullified in a way. I'm going to give you a framework to think about this. This is what I call the bucket theory, where the cash flow bucket today is that red bucket. And then number two is the orange bucket. Number three is that teal bucket. But this is my theory on the way to do things where you fill up the first bucket, your cash flow today bucket. For most of the people in our community, people are trying to shoot for $15,000 to $50,000 of passive cash flow a month to pay for their affluent lifestyles. Certainly when you get above $15,000 to $25,000 a month, that's a healthy zone for a family at that point. Obviously, when you age and your kids leave you, your needs become less. But hey, that's where you start to find more expensive wines and you go more extravagant vacations. You start to fly first class all the time. That's why we put a big range there. The idea is there's a big range for everybody here, but you want to try and fill your cash flow today bucket that you use up first. And one of the big ways of storing that liquidity is through an infinite banking or credit investor banking plan. For more information about that in the e-course, go to thewealthelevator.com/bank. If you're new, we have a 2-hour long webinar that should be a good quick primer for you on that whole strategy. But great way to sort of asset protect that chunk of money and have it grow. There are very few things that are risk-free in this world, but that's probably where you're going to get the best security in terms of a liquid holding. Keeping with the theme of mistakes, the mistake that we're all taught is to fill up your legacy bucket first. Invest in your 401k so you have the money later, which comes from a good place. but it's obviously opposite what I'm trying to teach people here, right? The problem is most people never get to fill up their today bucket because they never get to fill up that completely number two bucket. What I'm saying here is fill up the bucket sequentially. Number one, fill it up, then you start to fill up number two. I think people try and fill up one and two concurrently. And because they're never concentrated and they're investing in the wrong things and they're paying a lot of taxes, they just never are able to get very far. And by filling up bucket number two first, you don't get the passive losses to flow to you personally. So you get killed by taxes, which is also a big driver why you never fill up that bucket number one unless you make a phenomenal salary, own your own business, or extreme saver. At this point, once you have your lifestyle paid for with a safety factor, then you start to fill up self-directed IRAs, Roths, solo 401ks, defined benefit plans. That money is considered legacy, meaning you are not going to be using it personally. It's more for your kids or the legacy. The one exception, as I mentioned a couple slides ago, were extremely high income earners that are on the younger side. And then if you want to do a HSA in here, I think the HSA somewhat is exception to the rule. But I think if you're understanding the themes here, you're not filling this bucket up unless you've come to Hawaii with us and had the conversation. There's another legacy bucket beyond this for people who make boatloads of money. This is when you get to $5 million, $10 million net worth, where you start to put your money into maybe a nonprofit type of arrangement, other tax reasons and liability reasons for doing that. But this is just showing the sequential flow of how you fill up these buckets over time. Lessons I've learned along the way: normal people focus on debt and interest rate. I can tell who are some of the less sophisticated investors because the first thing they talk about is how low their interest rate is on their home. I've got like a 2.5% mortgage. Like, that's only one half of the equation. How much lazy debt equity do you have in there not doing anything is the bigger picture, the holistic picture. Then they focus on debt, right? Everybody focuses on the United States has got trillions of dollars in debt. But what is the debt service of it? What's the debt service coverage ratio? And what is the percentage of general GDP on that, right? There's a bigger picture on it. Sophisticated investors focus on cash flow, which is the safety of their investment, or debt service coverage ratio on the particular investment, and the overall impact to their net worth. Again, going back to that mistake I see most landlords making where they have great cash flow on their investment of that $1 million paid off rental property, great cash flow, but their net worth isn't growing diddly squat. Sophisticated investors don't really pay off properties until they hit a certain inflection point. They know the best use for their money is to grow and grow more assets perpetually. And that's up to you guys, whether you want to get up to $5 million and then shut off the engines, or get to 10 million, or have your family start to grow a more formal family office, which is why they join our family office group to grow from there. Maybe they take less risk, but they're still in that growth mode. If you're not growing your net worth over time, you're going to lose it. The next generation messes it up for you. This is why they always say 90% of wealth leaves family in 2 to 3 generations. But it also applies to personal development. If you and your spouse aren't growing together, you're probably just separating apart at some point. If you're not moving forward, you're moving backwards, that whole premise. And the other thing is to focus on return on equity, monitoring that important metric, as we shown on the previous slide on that chart. Refinancing or selling to maximize the return on equity while optimizing the debt service coverage ratio and cash flow. If you want to maximize return on equity, you're going to be taking on more risk. But if you notice I use the word optimizing because it's different for where your risk tolerance is. And this is where it comes down to your net worth, right? Where you are at your journey. If you're younger, under $3-4 million net worth, you've probably got to take on more risks to get to where you need to be. Me personally, I've maybe gotten above that hurdle. I'm nowhere near where I want to be, but I may be more conservative on how I do things in the future. Of course, I think you never know what's happening on somebody's portfolio unless you know the big picture. I personally use the dumbbell theory where if you think of a dumbbell, it's lopsided on both sides and there's really nothing in the middle. The average weight or the center of mass is in the middle, but you can't go by that. The dumbbell meaning like I may have some more aggressive investments on the side, but it's counteracted with a lot more conservative investments on the complete opposite end of the spectrum, like life insurance, infinite banking, those types of strategies. I don't have stocks. I don't have traditional investments like that. I'll make alpha by going into private equity and real estate, but I'll have security and be able to sleep at night with my life insurance on the other side. If you go by the average center of gravity, I'm weighted in the middle. So that's from the outside. My situation is perplexing, but I have a method to my madness. And I think people somewhat, if they get into our group, at least they can speak the language as opposed to I just follow what Vanguard said to do for my age and just go with this cookie cutter asset allocation mix. There is no normal out there, is what I'm saying. The best way is to pull best practices. Hopefully, you build some good relationships with cool people who are aligned on your trajectory and have a little fun along the way doing this. Possible funding sources for investing in new deals. When we do the in-person seminars or the retreats, we'll have or like we'll break people up and we'll actually help people like identify where their lazy equity is. But at the end of the day, it's up to you to decide where you're pulling funds from or not. Maybe you're exactly where you want to be. I always say, if you're not to 3, 4, $5 million yet, you're not there yet. You may be incredibly wealthy compared to your peer group, but there's always a next shelf. You always want to be content and happy with what you have and be appreciative. But the way I look at it is that you always have to be growing for the next step. I've been lucky enough with the podcast and the influence and brand that I've created in the community. It allows myself to interact with higher net worth people. We buy apartments from these types of people, these family offices, these incredibly wealthy people, 100, $200 million net worth above. And then so I hit these stratospheres and meet these people and I start to see what are the strategies that they're doing and what's on the next level. And this is what helped me create the Wealth Elevator book. And I'll continue to pull best practices forward. And when we do the retreats, what the plan is to tease out a specific strategy that somebody who has $25 million might employ. So not only is it fun to see those strategies, but you may not be ready for it. But where is the mindset? What is the strategy that you can emulate if you're $1.5 million net worth that this person is going to? Another example, I fell into this fallacy myself. When I was in my 20s and probably my 30s, I wanted to leave my day job. That was my number one goal. Part of that, I realized as an intermediate goal was I needed cash flow. So I started to invest in the turnkey rentals, the buy, hope, and pray strategy where there's no value add. You're just hoping that the value goes up, and that's not a good strategy. But I was rewarded by monthly cash flow. And what I realized, yeah, sure, that helped me quit my day job because that was the pain point at the moment. But that was a very nearsighted goal that I see a lot of new people coming into our community with. You may want cash flow today or on a monthly basis, quarterly basis, but that's not what wealthy people do. Certainly when you get above $5, $10 million, because you have other investments, you have a nest egg, you may even be working your day job or still working your business at that point. So you have cash flow to put food on the table. Those people are more situated with the viewpoint of picking investments that are better for the longer term, more safer, and not necessarily like they give up cash flow for better returns in the future or security. So that's a good example of if I didn't have the perspective of somebody who was on that next level beyond and the next level beyond, we would just be working on what is perspective of today. And the perspective today, whether you're still investing in traditional investments on that step number one, or you're already with rental properties going off into the future, without that perspective, you can't begin to make the steps in the right direction. And then we kind of work on this workshop planner in the workshops. Of course, so many different permutations and commutations. Another quick thing, 529 plans, definitely not what the accredited, sophisticated investor does. This is just no different than a 401k QRP plan out there. Just another example of what traditional cafeteria options people are stuck with. But this is just some of the mistakes or what normal people are talking out there. I think what we try to do is pave the quick path to where we want to be. It's not as simple as a band-aid. This is a holistic strategy. That's why we say join our community, get more involved. The strategies change, right? You need a dynamic type of plan moving forward. But with that, we are end of the module here. What we wanted to do with some of these maybe myths out there is neutralize it to a point where you can make the best decision for you. I think ultimately what it does come down is to community. Unless you have people in your five circle that are doing this type of stuff, thinking for themselves, it's very hard. In this online masterclass format, I've tried to make this the most scalable way possible for you to digest this information. And we'll see you guys in the next module.